Hey guys, UFO Yotes here. Yeah, really not a good week from any single side of the market. I'm gonna go ahead and bring up the uh, heat map here. I think it's like markets heat map. So last week, you can see the market was pretty red again, right? So these last few weeks, really, last 2 weeks specifically, have been pretty red for a few. Besides for a few sectors, you can see financials got hit like a brick. Um, you know, technology as well, just all around not doing amazing, which really sucks. And if we go to even the month view, you can see the same thing is kind of true for a lot of these sectors, which really, really sucks. Um, moving back into our portfolio, yeah, not doing very good, right? We're down, I think, $468 this week, which really sucks. We're just barely above our the amount of money we put into the account. Like it's good, we're still positive, but actually we're still doing better than the S&P 500 portfolio, whereas where that would be $10,932. You can see this is the second worst week since when is this? September 8th. It's the second worst week since September 8th in terms of just raw percent difference. Um, and that's a lot for the S&P 500 portfolio. Technically, we've actually had way worse weeks in our portfolio, so I'm actually quite lucky there. Um, but you can see like the last little bit has been pretty rough. We had this kind of thing at the beginning of the year as well. You can see this amount here. I think some's to negative 15%. If we just go actually year to date, let's just pick this here. We're down 11%, whereas this is actually down 3%. So not very nice. And we can go into the overview page as well. So currently sitting at these amounts. I'm gonna get this dividend yield updated real quick. All right, we got that updated. It's 28% now, but we're still sitting around with those three holdings. And again, I haven't fixed this number, so it's technically the last 2 weeks. Uh, which yeah, but um, anyways, you can see here that it's just not going very good. That blue line, which is our portfolio, is starting to diverge into the other ones. Let me see if I can zoom in here close enough to where it's easy to see that. Wow, this is terrible scaling, but you can see there that they're both dipping beneath, or they're very close. I know that the orange one is dipping beneath the red line, which that red line is just the cash that we put in. And yeah, you can see the MWRR is also just trailing downwards, which really sucks, right? Like, it really sucks. But this is honestly a wake up call, right? For me, and it should be for you guys that might be really all in, like I am, on these high yield dividends. It's a wake up call because realistically speaking, it can't keep running upwards, right? We're not going to be in a bull market forever. And to be completely honest with myself, like I should have seen this coming because we've only seen these funds in a bull market. Like there have technically I got in a little bit later than maybe most of you have. Who knows? For example, I think YMAX started in March, but I got in roughly way later. Way later. That's what matters. And I've only seen really up from here until the last month, or sorry, until the last really beginning of the year. Um, and I just keep finding myself coming up with excuses for why it's going down and oh, it's going to go back up. But the fact of the matter is, something we do know about these funds, these yield max covered calls, is they are terrible at regaining their lost NAV, right? They're very good at giving you the dividend, And that high yield dividend, right? Like last week, WiMAX was 80%, I think, or something crazy like that. But the dilemma that you run into is when the market is a bear market, and then, like, let's say the next week or the next month, it goes back up. You do not have the ability to go all the way back up to where your position was. It is capped. So it really blows, right? We are essentially cutting ourselves off from gaining that growth back. And then what happens is those dividends, one way or the other, have to be coming from somewhere. So either it's from our pockets in the sense that the money we put in is just coming back to us, or more than likely, the dividends are just going to keep getting smaller and smaller. Now that percentage might be high, right? And that's the real thing you got to keep an eye out on is, like I always say, this total return. But when you look at just the raw percentage of the dividend annualized rate, it's really easy to keep yourself, you know, in a positive mindset. But you can't. Like, again, last week was 80%. That's not because they did well on premiums. It's actually because, well, they did a okay job at premiums, right? But the price also fell so far that by the time that they paid out the dividends, the amount of money percentage-wise, I don't know if that makes sense, was actually higher because that came later. So I digress. Point is, this should be a very eye-opening part of the year for us to maybe not dip our toes so far into the water and, try to dry ourselves off. And part of doing that, I'm still kind of keeping this position open, but even this actually had some growth again, which was very interesting. Sorry. Well, I meant MSTR had some growth, which was very interesting. So this dropped quite a bit. It was actually pretty high. We were at one point, I think, up to like 1,200, 1,400 here. But, we slowly fell down again, which really blows. And that happened in like 2 days, right? Fell $1,500 in 2 days or something crazy like that. The good news is for this side of the portfolio, though, Bitcoin is continually going down, right? So it's down to 80,000 again, which is very interesting. You can see if we go to the month view, this is almost the lowest that we've seen, but it is technically in that same range, 80K. When we saw that growth back up, March 3rd is when we saw it here, when we started to lose all that. March 3rd to March 5th. March 3rd to March 5th here. Like these went up. So Bitcoin is obviously really tied to, or MSTR is tied to Bitcoin. But now that it's going down, we're probably going to see this short position go back up, which is very nice. With that being said, I am making some big changes to the portfolio. And I've talked about this for a while. It's just that I haven't had really a lot of time to really look into this. And I've been really thinking about how best to do this. So what I'm gonna try to do this time, or like now, from now on, is, well, actually, first let me go over. We got $80.66 from WiMAX, which is awesome. That's a lot of money. But I'm adding a new slice to the portfolio. And anyone that's unfamiliar with M1 Finance, you can basically add these, well, it's like a pie, right? That's kind of where they give it. So this is called a pie. This is the Youthful Yields pie. And in this pie, I have 3 slices now. I have QTAL, which is okay. Well, that's not cool. QTAL is basically a combination of BTAL and QQQQ, or sorry, TQQQ, and that's 50-50 split. Okay, this is basically a anti beta fund. So whenever the market goes down, this tends to go up. It's more of like a hedge against TQQQ because it's very volatile. But anyways, that's what I've been running for a while, as well as high yield dividends, which currently we just hold WiMAX. And I'm going to make the majority of my portfolio, 55% of my portfolio, this balanced growth portfolio. Okay, because what I'm trying to do is essentially get really balanced out. Now, I could just do the SPY, but I don't think it's enough growth for me. And I could just do SCHG, but I think this is a little bit more fun. And technically, we could get a lot more growth as well out of this. With SCHG, it's more diluted because they have more tickers. But the idea here is we have 10 different sectors. So within each slice, you can have multiple slices. So I have 10 slices. Each slice in here is another sector, right? So technology. And then in here we have the, our items, our tickers. So we have Apple, Google, Microsoft for technology. We have Eli Lilly. We have United Healthcare and Vertex for our healthcare. We have Amazon, Costco, and Home Depot for our consumer discretionary. We have NVIDIA, AMD, and AVGO for our semiconductors. We have Visa, MasterCard, and Morgan Stanley for our financials. We have RTX, DE, RTX, Deere, and Honeywell for our industrials. We have ExxonMobil, Chevron, and Enphase Energy for our energy. We have Procter & Gamble, Coca-Cola, and Pepsi for our consumer staples. We have Next Era, Duke Energy, and Southern Company for our utilities. And last but not least, real estate. We have Prologis, I don't know how to say that, American Tower Corporation, and Realty Income Corporation for our real estate. So they're not equal weight. You'll see that we have 4%, 5%, 6%, so on and so forth. We are still risky, right? This is another thing that we can do outside of SCHG. We have a pretty high concentration of our portfolio, or this half of the portfolio, or this part of the portfolio, in very volatile funds, right? So like in semiconductors, we have NVIDIA, AMD. Those are pretty volatile funds, and there's some other ones here. But you'll notice that we have the high growth funds here, and offsetting those, we have some other maybe growth funds, but maybe not high growth, but they're low volatility funds. So I only have the ability to go back a little bit, but if I go into My Pies and then go to Balanced Growth Portfolio, we can see here year to date is down 1%. Whereas if we were to look at something like our high yield dividends, year to date is down 5%. And QTAL year to date is down 5%. So you can see there that it's already kind of doing its job, keeping us pretty even, and that's what's kind of what counts. And with a year, we have about 13% growth, whereas all time, which technically only goes back to 2023, we have a 32% growth rate, which is pretty good. It's pretty good. I'm gonna pull up the number for SCHG, so just give me 1 second. You can see it's pretty on par with SCHG, which is about a 34% growth between then and now. And then, is July 30th. But also, there's a few things that we also get. We get some dividends out of this, as well as I'm pretty sure this has a lower max drawdown than SCHG, which is another very, very awesome thing. So it's going to be interesting to see how well this kind of performs going forward. Obviously, we have some companies in here that are historically have high growth, but who knows whether or not those are going to continue to have that high growth. Obviously, something like NVIDIA could just die tomorrow. It won't die tomorrow, obviously, but it's had its up run for quite a while, is my point. So we're not going to be seeing a crazy amount of growth. But the idea here is, despite that happening, that's 12%. This semiconductors part is only 12% of our portfolio. And of that 12%, NVIDIA is only 34% of that. And also, of that 12% and 34%, this is also only 55% of our portfolio. So if NVIDIA falls, we're not taking a humongous loss. So I think this is a kind of a good way to go forward. And I'm kind of hoping that it continues to keep going like that, but we'll see. Another thing is, you can see the dividend rate here and the expense ratio here as well. In fact, if we go to our youthful yields portfolio, you'll see 33 holdings, 12% dividend yield, and a 0.56 thingy here, as well as you can see this is basically 1 year is 18%. So there's that. It was higher, but it's obviously dropped a lot. So it was up to 28%. But if we go back to that balanced portfolio here, that would be technically. Oh, that's weird. It doesn't show me the percentage, but I digress. The whole point of this is that we're trying to save our butts, right? I really do still like the high yield dividends. I'm not going to throw those away. And that's another thing that's really important about this time. You do not want to sell your funds no matter what, because hypothetically this could go down, and the second you sell is the second you lose all your money that you would have gained on the upside. Now, the only time I would actually suggest selling is if this is a life-changing amount of money, right? For me, it's not. If this portion of the portfolio were to go to zero, I know that I can live without that. But if you have your entire life savings into this, single fund or into the YieldMax stuff, I would definitely be, considering maybe selling off some portion of your portfolio, just to kind of offset that and maybe put it into some more well-known stocks. But of course, that's not financial advice. I'm just talking on my butt. I haven't been in the position that most of you guys are, and I obviously don't have a lot of capital compared to the average person investing in these kind of income funds. So do obviously what you want with your money, but that's just, I just want to give a word of caution to those that are in these funds right now. There are very few funds that I'm still really considering to be very stable high yield dividends. One of them is XDTE. Now it's down 6%, but that's still relatively normal for XDTE. We can see here. Sorry, it's down 6% on the price, but we also need to look at total return, not just price return, and we can see it's only down 1.85%, which is actually lower, or technically higher, than S&P 500. So that's another thing to keep an eye out for. And remember, this is hovering about 15 to 20%, which is still above way more. Like, this is way above most dividends that are stable. So if you guys are really looking for something that's relatively stable, this is the only one that I've seen still to date that I can really recommend. I was trying to look into, I'll just put it here, AIPI, but that's running into the same problem as YMAX, which is it's down 7%. YMAX is down. YMAX. I don't even know what that one is. YMAX is down 5%. So, it's not as much. But this is my point, right? Like, it's gone down, so it's hard to say. And if we even look at like a year's difference, we can see here XDTE is 14%, and it's above the S&P 500. And you get that ability to keep your what am I trying to say here? You get income out of it. So that's why it's so cool. But I don't want to drag this video on forever. But I'll leave you guys with this. This is a very hard time to go through when the market is in a bear market. But what's important is to remember that eventually it will go back up, but you don't want to just hold the bag. You should have some kind of backup fund if you don't already. And that's why I'm kind of coming up with this new portfolio idea. And yeah, I wish you guys the best of luck, obviously. You know, I don't want anyone to lose all their money here. And I hope that I didn't persuade anyone to jump into WiMAX, for example. Um, Obviously, you can't trust everyone on the internet, and you should make your own, you know, opinion. You should formulate opinions by yourself and not just what some random guy tells you to do. So, hopefully, that's not the case, and hopefully, you guys have a backup plan like I do now. But as always, I wish you guys a wealthy future.